Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 87, all about the first home guarantee. There's my disclaimer. Facts and figures in today's session, information only, it's not advice. Okay, the first home guarantee. What it is, it's part of the home guarantee scheme that was set up by the Australian government, basically to help support eligible home buyers to buy a home sooner. So basically what this is all about, it's effectively, instead of someone needing to have lender's mortgage insurance because they don't have a big enough deposit, the government is coming in to basically take up that role. So they means you can basically have a deposit as small as say 5%. And instead of normally you'd have to have lender's mortgage insurance because we don't have a 20% deposit, then basically the government is saying to the bank, yep, we'll be the guarantor. Well, if anything goes wrong here, the bank can come back to the government, say, okay, this person can't afford their loan, what are you going to do? And the government then comes to the rescue from that point of view. So it just literally means that the purchaser of the house can have as little as 5%, meaning that the government is going to basically stump up that extra 15% to give them the 20% deposit they need. Now, they're not providing 15% of the money. That's not what's happening here. It still means that the person buying the house would still have to have get a loan of 95% of the required amount because they've only got a 5% deposit, but it means that they can avoid the lender's mortgage insurance, which obviously could save them, thousands or tens of thousands of dollars if they were getting a reasonable size mortgage there. So it's not a cash payment or a deposit. It's just literally be saying it's becoming the guarantor. Becoming the guarantor. Now, there are obviously with any of these things that can sound good, but there are restrictions, there's caps and everything in place as well. Now, from July 2023 to June of this year, 2024, there are only 35,000 places available. Now, when you consider how many people around Australia are probably trying to buy their first home, it's really not a big amount. And when you look at all the rest of the restrictions on this, the numbers certainly start to dwindle again as well. But yes, it's a first in, best dressed type of arrangement for the people who apply, and they look at your scenario and to see whether you're eligible or not. So you need, or if you're the person buying, somewhere between 5 up to 20% of the eligible property you need to have saved, and therefore this will then kick in. Now, the money can only be lent through this scheme through participating lenders. Not every bank will indeed participate in this scheme, allowing the government to be the guarantor. And so on the Housing Australia.gov.au website, these are the people that are running the scheme for the government, there is an eligibility tool that you go through to find whether you're eligible. And then there's all these links to find out who are the participating lenders, who's actually going to lend us this money if we're eligible and can get into the scheme. Now, the eligibility is not too bad. In the regard that it can be an individual or it can be a joint application, so you and your partner, so to speak. You've got to be Australian citizens or effectively permanent residents at the time of the loan, and you've got to be at least 18 years of age. So yeah, look, not too bad. But it can be the earnings that can be caused a problem here. So it's up to $125,000 for individuals or $200,000 for a joint applicant. So if you're earning more than that, you are not eligible for the scheme. And and it gets getting difficult because you can imagine the people who can afford to buy houses are the ones that have got a higher income. But anyway, and that's your income as shown on your notice of assessment from the ATO. So that's what they're going to look at. They're not going to assess what you think you're going to earn or anything like that. They're actually basing it on your notice of assessment. It means that to be eligible, you need to be an owner-occupier. So effectively, you can't do this if you're going to use it for investment purposes. So it's got to be a home that you're going to move into and be the owner-occupier of the property. And as a first home buyer or a previous home owner who haven't owned their own property in the past 10 years. So it can be, doesn't have to necessarily be your first home, but if you have had a home before, it's got to be 10 years since you've actually owned property in Australia. So, but ideally, it's obviously it's trying to focus on the first home buyer there. Now, not only are there eligibility criteria and with the income restrictions, there's also a restriction on the type of property you can buy and the value of the property that you can buy. Now, under this scheme, it's got to be either an existing house, a townhouse or apartment, or a house and land package, land and a separate contract to build a house, or an off-the-plan apartment and townhouse. So we can't be buying things like boats or caravans and all these other things. It's got to be just a standard house, townhouse or apartment, either as a package or basically being built and whatever. Now, I'll say on that the website, there is a property price cap tool. Now, the idea of that tool is to basically look up your area where you're intending to buy to find out what the property price cap is. So you may find that it's only in your area, might only be $600,000 or $700,000 and so it goes on, in which case, you may not even be able to find a property in with that cap. So it is going to do a bit of a restriction here. That's really going to limit some of the chances, especially if you wanted to move into a more affluent, suburb in your city, because it's actually just based on effectively mainly on city. It is done on a postcode arrangement. But anyway, grab the property price cap tool on their website, have a look to see whether it even fits in with what you're thinking you're going to be doing it there. There is time frames that this thing can't drag on forever. So there's time frames and criteria that apply on the different property types. Obviously, if it's an existing house, it's going to be different than if you're doing it off the plan or something like that. And so any contract of sale and any building contracts, they've got to be done within specific dates. And that could be problematic, if obviously there's some sort of delays or whatever causing you to, sort of push the boundaries, so to speak, on what you're allowed and can do under the scheme. To give you an idea, this is the capital city there that you can see there in capital cities in Tasmania, Hobart 600 compared to 900 in Sydney. Now, whether that's realistic or not that's the $64,000 question. As I say, whether you can actually find a property in that price range. ACT 750 where I'm from. You'd be probably struggling to buy a house for 750 in the ACT. Units perhaps and so forth. But yeah, certainly onto the lower end of the scale as to what the availability is and compared to what you can really purchase underneath this scheme. Now, there are two other versions of these home guarantees. There's a regional first home buyer guarantee, where effectively that's anyone in a regional home to get in the home, they can get into the deposit of as 5,000, but there is an extra 10,000 spaces available on that scheme for regional areas. But the one that's probably a little bit more interesting is this family home guarantee one, where if you are a single parent, an eligible single legal guardian of at least one dependent, and you're trying to get into a home, then you can use the scheme as long as you've got a deposit even as little as 2%. Now, there's only 5,000 places available, but whether there's 5,000 single parents that could afford to buy a home with basically borrowing 98% of the house value is another serious question. You can imagine being a single parent and you've got to be underneath these income caps, and then you've only got 2%, you're borrowing 98%. This is going to be your loan repayments are still going to be quite hellishly expensive, but certainly worth a look at. And if you're eligible, to see whether you can apply and see whether you can get in under the quotas and the number of people available and so forth. Because I say, if we can avoid paying tens of thousands of dollars in mortgage insurance, then nice situation to be in. But whether you can get what you want for the value you want based on your income and where you live, probably that's another question. Anyway, happy to have a chat about it, and I look forward to you joining me on another session.